So why did a perfectly flawless, record-breaking earnings report trigger a stock slide? That is the biggest question we need to answer in this explainer on Nvidia. Back on May 20, 2026, Nvidia posted an absolutely unprecedented $81.6 billion quarter. I mean, they executed flawlessly. But by late June, the stock actually slid toward its yearly low, hovering right around the $194 range. Look, when a company crushes every single metric and the share price still takes a hit, you know a fundamental shift is happening. Just to put these verified facts into perspective, Q1 fiscal year 2027 revenue hit $81.6 billion. That's an 85% jump year over year. And they didn't just grow the top line, they held on to a staggering 75% gross margin. Historically speaking, numbers like that usually spark massive market-wide rallies. But here's the reality. The market is repricing the valuation multiple, not the actual business. Seeing the stock drop to that $194 level, that is a classic sign of late-cycle multiple compression. Essentially, investors aren't doubting Nvidia's pristine operational performance at all. They're just flat-out unwilling to pay the same premium for the stock because they're anticipating a cycle peak. If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel. Right now, we're doing a completely objective, evidence-based investigation into Nvidia as of June 25, 2026. We are separating the hard, verified facts from market interpretations and mapping out the future scenarios based strictly on the data. Here is our agenda for this explainer. We'll cover market drivers, the bull versus bear cases, business quality, valuation, and sentiment, upcoming catalysts, and finally, an investor decision framework.
Section 1. Market drivers and fundamentals.
Looking at the Q1 fiscal 27 financials, net income came in at $45.5 billion. But what makes this so exceptionally rare for a hardware company is that massive 75% gross margin. You don't get that kind of profitability just by selling silicon, right? It's heavily driven by their deeply entrenched software ecosystem, which commands a total premium in the data center market. Now, checking out the competitive landscape, we see a pretty stark reality. Nvidia still commands roughly 80% of the AI accelerator market revenue. AMD is sitting at an estimated 5 to 7%. But you know what the real structural threat is? It isn't a two-horse race. It's custom silicon. Hyperscalers, think Broadcom, Google, AWS, they already hold a 14% share, and it's growing. Broadcom's AI ASIC revenue alone just passed the $20 billion mark. Section 2. The bull and bear cases. So the bullish reality really rests on those dominant 75% margins, plus this massive, entirely new $200 billion total addressable market opened up by agentic AI. We're talking about systems that can literally operate independently without a human prompting them. Also, Nvidia hits about 50 to 55% model flops utilization. That means their chips run workloads way more efficiently than rivals, locking in their lead for large-scale training. On the flip side, the bearish reality points to those custom ASICs acting as a hard ceiling on hyperscaler demand. Add to that the harsh geopolitical reality of a potential $8 billion hit from China export curbs, and you've got a serious counterweight. When we talk about business quality, it all comes down to the competitive moat. Sure, AMD's MI350X matches the new NVIDIA B200 in theoretical raw computing power, or teraflops, and it actually beats it on memory capacity. But here's the catch. NVIDIA's CUDA software monopoly gives them a 10 to 25% real-world performance advantage. AMD gets you roughly 45% utilization, whereas NVIDIA's ecosystem efficiency makes them the absolute default choice for those massive training clusters. And we can't ignore the geopolitical tail risks. They are severe. China used to make up over 20% of NVIDIA's data center revenue. Today, it's down to just 9%. Now the company is actively trying to mitigate this by designing new, compliant chips, like a cheaper Blackwell variant, and working hard to negotiate export licenses. But at the end of the day, national security trumps commercial exports, making this a permanent structural headwind for the company. Section 3. Valuation and market sentiment. Right now, we're seeing a massive institutional contradiction. On one hand, the board of directors just greenlit a staggering $80 billion share buyback. Traditionally, that's a huge signal that leadership thinks the stock is undervalued. But at the exact same time, we're seeing heavy insider selling. Director Mark Stevens notably just offloaded 885,000 shares. That's $186 million. So capital allocation is signaling confidence, while insider liquidations are screaming caution. Looking at the verified valuation data, we have a trailing PE ratio of 30.2 and a forward PE sitting right at 20. This tells us exactly what the market has priced in. They fully expect aggressive, continued revenue growth. Make no mistake, any miss in execution or any dip in hyperscaler capital expenditures is going to immediately compress that multiple even further. The options market completely backs up this tension. As of June 25th, 2026, the volume put/call ratio is sitting at exactly 0.61. Statistically speaking, that is perfectly neutral sentiment. The broader market is completely undecided right now on whether we're going to see a breakout driven by product cycles or a breakdown from macro and regulatory pressures.
Section 4. Upcoming product catalysts.
Nvidia's execution timeline is absolutely relentless. The Vera Rubin platform is launching in the second half of 2026. It uses faster HBM4 memory, which drastically cuts down the cost of generating AI outputs, what we call the inference token cost. Following that, in 2027, we get Rubin Ultra, deploying the massive 576 GPU Kyber rack architecture. And they've already confirmed the Feynman architecture for 2028. So the momentum is heavily weighted toward these upcoming back-end product rollouts.
Section 5. Investor Decision Framework.
If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel. Now, here is the ultimate standoff. The strongest bull argument is that $200 billion runway created by agentic AI and robotic physical AI. Nvidia is uniquely positioned to dominate that space. But the strongest bear argument, that's the undeniable gravitational pull of hardware multiple compression paired with the expanding footprint of custom silicon from the hyperscalers. For swing traders, the evidence gives us a pretty mixed picture. You have real reasons to be constructive, mainly driven by the momentum of the impending H2 2026 Vera Rubin launch. But the reasons to be cautious are backed by that perfectly neutral 0.61 options sentiment and the major headwind of $186 million in insider sales. Based on the data, things lean slightly toward caution until that multiple actually stabilizes. For the long-term investors, the case to accumulate is built entirely on absolute market dominance. The CUDA software moat essentially guarantees that Nvidia stays the default infrastructure for frontier models. Conversely, the main reason to wait revolves around capital expenditure fatigue. If Amazon, Google, and Microsoft start signaling a slowdown in AI infrastructure spending, or if they shift heavily to their own Broadcom-designed ASICs, we are definitely going to see better entry points emerge. If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel. Based strictly on the current evidence, this stock fits the classification of hold or accumulate on weakness. The underlying fundamentals are absolutely pristine, but the valuation multiple is actively compressing. The smartest strategy right now is to wait for definitive CapEx guidance from the hyperscaler earnings calls before committing fresh capital. So the final question you really have to ask yourself is this: will the hyperscalers' capital expenditures actually justify a $200 billion agentic AI runway, or is custom silicon about to put a hard ceiling on the world's most valuable hardware maker?